First off, investors, Merry early Christmas, as this is the last stock talk I'll be doing for the holiday next week. Second, we've got a lot of great questions since the election on our outlook for the economy and the markets for 2025. We've already addressed the key issues we see affecting the markets in 2025. However, many other topics and more minor issues keep popping up in many of our viewers' questions. Hopefully, we touched on many of these topics last night in our live stream with Troy, Charles, and myself. While the focus of last night was recapping 2024, it's our investment team and financial planners' goal at Oak Harvest Financial Group to focus on the future, not to dwell on the past. The link to last night's live stream is in the description below. Check it out. If this is your first time watching our content, or if you're a returning viewer but haven't subscribed yet, please help us reach 1,000 subscribers before 2025 by hitting that subscribe button below. And if you'd like to be notified every Friday when we upload an episode, hit that notification bell as well. Also, if someone else might be a friend or a colleague might benefit from this content, please don't hesitate to share this video with them, investors. We've been in a bull market for equities. We've been in a bull market since at least 2011 secularly and cyclically, since the October 2022 low, as well as the October 2023 pivot higher from 4150 on the S&P 500. Our team has been discussing this since well before the election, why this bull could run and remain alive in 2025, regardless of who is elected. Without preempting our 2025 Market Outlook Summit that will take place in January at the Hotel Zaza here in Houston, here's a list of those things that we feel are most important to extending this bull market for another year. And investors, these are listed generally in order of importance. First, the S&P 500 earnings growth and growth rates continue to be strong. First and foremost, investors, stocks follow earnings and marginal returns on invested capital over periods measured in years. Second, interest rates, both nominal, real growth rates, and inflation expectations, need to trend lower over the long end of the Treasury curves, which are generally market-based. That is better for equities than higher trending interest rates. Why? Because the terminal value for equities is based on discounting their free cash flow over years back to present value. And when you make that calculation, the lower interest rate, your terminal value goes up. When the calculation is done with the higher rate, your present value for equities goes down. Goldilocks for equities are a stable to lower long-term interest rates, lower trending inflation, and stable to lower real rates. That's what happened in 2017, even with the Federal Reserve raising rates at the short end under Trump 1.0. The next point that people discuss, stock market valuations. Nope. They aren't low, but don't get me started on this topic. They are a horrible timing tool for selling or calling tops. See the three above notes. Valuations are not cheap based on history, but investors, you rarely get cheap unless you're in a recession, and we're not in a recession right now. We had one of those in the first half of 2022 when stocks dropped 25 to 35% in the S&P 500 and 50 to 75% in the tech-heavy NASDAQ. Next up on the topics, a Federal Reserve that is not a headwind to investing, but is looking at rate of changes in the economy. They don't loosen too much, but they don't get itchy trigger fingers and tighten either. A new data point, the 10-year to 3-month yield curve uninverted on December 13th, 2024 for the first time in over 700 days. Investors, this has been a leading indicator for recessions in the past. But remember, it didn't catch the first half of 2022 recession that we had, but it is worth keeping an eye on this year. The next topic to watch in 2025, keep a watchful eye on the US dollar basket. There is no de-dollarization of note in the global markets. There is a broad move across fiat currencies of debasement. Remember, investors, currencies are a relative game. The S&P 500 and its returns would be best served by a gradually weakening dollar in 2025, much the same way it weakened in 2017 under Trump 1.0. A weaker US dollar would broadly help the earnings of large cap multinational companies. Think of McDonald's, Pepsi's, Coke, Starbucks, and technology. A slightly stronger dollar has been a headwind to many large cap stocks in 2024. Just ask Oracle and Adobe after they reported their most recent quarters last week. The next topic, tax rates for both corporations and individuals. Lower corporate tax rates for businesses means more cash for shareholders and hopefully higher ending investment returns as well. Lower to stable taxes for individuals means more cash in your wallet to spend as a consumer or to invest as an investor. It also takes the pressure off many investors who need to sell stocks now or in 2025 to beat the rush to higher tax rates in 2026. The next topic to watch in 2025, fiscal restraint in Washington, D.C. The much discussed DOGE effort under Trump 2.0 is necessary good first step at slowing and eliminating waste in our federal government. However, investors, you need to remember that whether you like Bidenomics IRA economic plan or not, many public companies and their shareholders benefited greatly from spending in 2023 and 2024, and it makes these companies' comparables more difficult to achieve next year in 2025 and 2026, particularly if those programs get cut back in a material way. What's good for the taxpayer and lower deficits on the surface might not be great to you as an investor. This is actually one of my biggest fears that can lead to slower growth in 2025 and 2026 and lower EPS than many think. Okay, next up, China's economic slowing and stimulus programs. Let's be frank, China's economy is a mess. There's no chance they're growing at the rates their government says. It's one of the top economies and largest markets in the world for products and services, and global stock markets and investors would be best served if they actually put in place some programs to stimulate consumption by their population next year in 2025 and 2026. Whether they are waiting to see President Trump's hand and game plan, I don't know. But they did stimulate in 2017, and their markets were one of the best performing asset classes that year, even with the Trump tariffs and geopolitical tensions. Okay, next up, tariffs. There's a great deal of discussion, debate, and hysteria in many circles on this subject. First off, yes, tariffs are taxes. Taxes are frictions to investors, and investors hate friction that separates them from their money and desired investment. Now, between 72 and 75% of the U.S. economy is consumption and service-based. Tariffs should not affect the service component, leaving consumption. When one breaks out the U.S. goods consumption by categories, overall, the necessary goods that we import to survive is relatively low, and since the initial Trump tariffs were enacted during his first term, most international companies have diversified their manufacturing supply chains away from China already. The groups that might be hit bad, autos, that's likely, as well as some other electronics. However, we are energy independent and now large exporters of BTUs in the energy field. Okay, next up, immigration policies. Yes, mass deportation of illegal immigrants would likely initially cause not only an economic slowdown, but also increase our service inflation. Our team seems softer policy once implementation begins, as a weaker economy is not in Trump's administration's best interests. Another topic for 2025, geopolitical uncertainties. These get talked about all the time by many economists and strategists on TV and in social media. Exactly how many times have they turned out to be relevant to your investments beyond 1 or 2 quarters? There's an entire consulting field around this topic, but I rarely, if ever, hear most successful longer-term investors talking about this subject. Traders, sure, they talk about it, but longer-term investors, Warren Buffett, technology and venture capital investors, almost never. Take a look at a few overlays of 2016 and 2017 versus 2024 and 25 for a number of the above data series. You can follow along in 2025 and see if the markets are rhyming again. If they don't, it's likely due to one of a couple of reasons. One, a stronger dollar in 2025, or maybe secondly, higher nominal and inflation-adjusted interest rates. Investors, S&P 500 7,000 in late 2025, is it doable in the next 12 to 14 months? The simple answer is yes. Is it easy? No, of course not. Black swans can hit, the unforecastable can play out. Maybe it is different this time. For now, the math I follow says 6660 would be a likely topping place in 2025. But investors, before you dismiss me or the likes of Tom Lee, who says 7,000 plus, or Rich Ross, who has been more right than wrong over the ongoing bull market, in favor of those retired billionaire hedge fund managers or doomers like Jeremy Grantham or Robert Kiyosaki or other newsletter writers who keep trying to scare you and have been horribly wrong, ask yourself, have they been right? Have they been right lately? Have they been right consistently? Or were they one-hit wonders from years, if not decades ago, who keep popping up on your social media feed because of a catchy computer algorithm that knows your age, knows your gender, and knows your political beliefs? Until proven otherwise, my suggestion to you is trade or invest similar to Trump 1.0 for at least the early stages of Trump 2.0, because it's many of the same people doing the same things, and therefore the outcomes tend to be very similar. A similar outcome to 2017 for 2025 would be S&P 500, 7,000 near the end of the year. So from myself, from the team here at Oak Harvest, from Eric behind the camera, have a blessed Christmas.